while since I had my last episode. We came to you on June 15th. It's June 24th now, so it's been a while. And there's two reasons for that. One is we've been traveling. And second, also, there's been a rotation in the market. And I think we wanted to wait and see how things settle in terms of capturing the gist of this rotation and explain what is going on. I think the concept of inflation is still big and very important. I want to talk about that. That was the last episode on June 15. We spoke about inflation. So I want to try to explain what I actually mean with inflation, with value and growth and all these things, what it means for us and what it means for our investment strategy. This is Not Even Wrong podcast. It's June 24, 2021. This is Crim Delco. Since the last update on June 15th, we are up 11%. For the year, we are now down 2%. The market is up 13.5%. We're underperforming by 15.5%. It's been quite a substantial reversal in our portfolio. We are now almost flat, which of course is great for us. Still disappointing, of course, given the underperformance in the market. But that shouldn't shadow away from the good news. And let's just jump right into it. So we had a reversal of a rotation that we've seen at the beginning of the year. So what happened is, let's go back to 2020. COVID hits, interest rates goes to zero, and the market starts investing in companies that the market in generally calls growth stocks. The way we see it is, these are companies that create something with intellectual property. So there are two types of companies in the world. There's the type of companies that grab land and then put a fence around their business and then try to raise prices and try to prevent others from grabbing land and putting fences around or breaking through the fences that they've just built. So this is the number one type of company. Examples would be GM, Ford, Coca-Cola, General Mills, real estate, etc. So this is what we call value companies, value stocks, the old economy. There's a lot of names for this. What's fundamental about these companies is they have something. They either own an asset, such as, let's say, they have a car brand or a Coca-Cola or something. There's some intellectual property there, but there's definitely no innovation. There's no iteration. There's no real economic growth, as Clayton Christensen would have formulated it. Actually, it's the reverse. It's incrementalism at best. But more importantly, let's say if you take Coca-Cola, they have a drink, and then they try to put their vending machines as many places as possible, so you don't have a choice but to buy their products. And then they keep raising prices on you. So those are the types of value stocks. And then there's the other type of company, and Tesla is the number one leader, I think, in that space, which is iteration, innovation, disruption, which is lowering the cost of iteration so you can keep disrupting markets. Disruption in a good way, which means 10x better and 10x less cost. This is the types of companies that we invest in at Orange Capital Partners. Our mission is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. So we need intellectual property, we need fundamentally new concepts and engineering practices to be developed and then instantiated into products. This is what we're looking for. So at the beginning of the year, after the COVID hit, and we had a huge run in these types of intellectual property stocks because the market said, well, we have zero interest rates. The land grab stocks will be dead because there's nothing happening. Nobody's buying Coca-Cola, nobody's buying real estate, nobody's going on vacation, nobody's doing things that normal people do in normal times. So grabbing land and raising prices will not work. For some companies it worked. Coca-Cola was able to sell Coca-Cola even though there was a lockdown. But let's say a hotel company like Hilton or Hyatt could not raise prices on you. Airlines could not raise prices on you. Car companies could not raise prices on you, etc. These things didn't work. However, innovation, new concepts, new engineering practices, they kept going on. Crispr was still working well, actually even better, because there was more demand for services that, let's say, Crispr companies could provide. So we have this dichotomy in the market in 2020, where all the capital is going into these innovation stocks, and the other stocks, with a few exceptions, are doing nothing or down, maybe are flat for the year, things like that. Then at the beginning of the year, we have this recovery from COVID. And what happens is we have, and this is what we discussed in our June 15th episode, we have this transitory inertia in supply chains, which creates inflation. So if you're a company, a land grab company, your main concern is always competition. If you sell Coca-Cola, you're not so much concerned about the quality of Coca-Cola or any of that stuff. You don't care because people will buy it. It's fine. Like you found something people like. The problem is competition. The problem is all these other brands that will put their vending machines next to you. How do you prevent that from happening? That's your problem. And in this supply chain constrained environment, those things are less of a concern. That's what the market started pricing in February, saying, listen, this is not so bad. Companies, these raise the price and just make more money by doing the same thing kind of companies, they will do well. This is what the market was pricing, and we had this huge run in what Wall Street calls value stocks. Now we have a transitory supply chain constraint that is abating. So now all of a sudden, it is abating. There were first news this week of the supply chain constraints on the chip side abating. So now we have, again, if there's more chips available for car companies, there will be more cars in the market. So now you have to think twice if you want to buy GM stock. GM stock has doubled almost. Well, not doubled, but it's up, let's say 30, 40% for the year. The GM cars are the same. There's no innovation, no differentiation. Supply is there, is a little bit constrained. That's why you can assume that their margins will be okay and that they will be making money. But there really isn't nothing substantially new or substantially better in the market that should make you want to buy the stock. And this is, I think, fundamentally what's going on across almost any kind of company that is in that sort of value space. And that's why we have a reversal. And it just started in this week. This week was the beginning of this reversal. And we believe that this reversal will hit, we are looking at massive, massive new highs for our portfolio companies and for stocks like Tesla and Crispr, etc. Because, when the market starts changing, when these shifts start coming, these are tectonic shifts, massive, massive shifts. So this is very good news for our portfolio. This is very good news for innovation. And this is also good news for people, because if we have this reversal of this inflation trade, that also means that prices will stop raising, going up. Now, let me discuss this a little bit more in detail, because there's a lot of pushback here. You can tell me, listen, why are you telling me this? I'm trying to go on a vacation. Prices are ridiculous. People are cutting supply left and right because they can't find workers. It is a nightmare out there. So why are you telling me price? Well, here's the thing. I've discussed in our June 15th episode the three types of inflation that we think are happening, or the three drivers of inflation, excuse me. Number one was this transitory supply chain adjustment. We said actually in June 15 that we expect this to be abating, and we were a little bit surprised ourselves. We couldn't time it, of course, but that it happened just a week later, that the market started pricing it in, was, of course, also not expected by us. We thought it will happen in the next couple of weeks, maybe quarter, but not necessarily next week. Then we said the second driver of inflation is the deterioration of government services. That is a huge problem, and it will persist. Government services are deteriorating across the world. And what that means in general is that we have less infrastructure, that we have less accountability, that we have also a big problem. People don't want to work. And this is something that we're seeing in the US also. If you get free money from the government, unemployment here, unemployment there, you don't want to work. We have a huge shortage of workers. This has to abate. And the third driver of inflation, kind of a reverse driver of inflation, which is innovation. So if we have a lot of innovation, that drives down inflation. If we have less innovation, then inflation goes up. We are traveling in Colorado now. We've been traveling for the last 10 days. Colorado is full of tourists. The problem in Colorado is the supply is limited. We're in Beaver Creek Resort. The hotels here have opened, some of them just a week ago. So there's a limited supply of hotels, limited supply of restaurants, limited supply of everything. Prices are through the roof. We expect this to abate. Like I said, the market is also pricing in an abatement of these dynamics. However, you need workers, you need people to work, you need to open up these hotels. You need to potentially also invest into new hotels if prices persist to be high. When I say high prices, I mean you pay $500 for a mediocre hotel for a night. That's a lot of money for things like for tourism, for example. So again, what we stated on June 15th in our episode still holds. We expect an abatement of transitory inflationary pressure. We expect the government deterioration to continue, but we expect the three big innovation drivers, which is artificial intelligence, blockchain technology, and Crispr, to drive innovation to the point where inflation actually will abate. This is the way we see the world, the way we see the investment world and the economy in general in the next, let's say, year or two. So that's why we're very positive. And like I said just a minute ago, we believe that we're looking at a quick reversal in our portfolio and new heights when it comes to our returns and all that stuff. So in summary, what we've seen in the last actually 2-3 days is a reversal of capital going from value stocks or less innovation and incremental type of companies into more innovation stocks. The reason we've seen that is because the market is anticipating an abatement of the transitory inflationary pressures which were on the economy. That has two big impacts for this particular trade. Number one, it makes these value stocks less attractive because they will be able to, they will have less ability to raise prices because they like inflation, number one. And number two, supply will be easier come by. So if you have more supply, then these types of companies have, of course, margin issues. Like one example, just this week we had an opening of a massive Las Vegas resort on the Strip, the first in the last 10 years. So that just shows you, if you think that you had, let's say, an investment in Hilton or Hyatt or one of these publicly listed companies that has Las Vegas properties, and you think, oh, well, great, I can charge $300 a night. Guess what? Supply is already coming to market, and it's only going to get worse if prices don't come down. So we have this reversal, again, out of those types of stocks into innovation stock. I think innovation doesn't change when it comes to, like if you have a company like Tesla, will not change based on the macro environment. However, the pricing of the assets, of course, will change. And this is exactly what's happening right now. And we have more investments into those types of companies. You can also look at it from a financial market perspective. What the investors are telling to companies is, look, I don't want, let's say, I don't want GM or Berkshire Hathaway to have all this capital because all they're going to do is buy back shares or invest in trying to prevent other companies from competing with them. This is what their main reason of, this is how they generate returns. I want capital to go to companies like Tesla because I want the world to become less inflationary and more disruptive, because this is where the big returns are going to be in the future. And because I don't expect returns on that value side of the equation to go up, I need to invest my money into the innovation side of the ledger. And that's where we stand at Orange Capital Partners. And like I said, we expect a very quick reversal in our portfolio, and also getting back to our highs and potentially even surpass our highs that we had this year. So the last point I want to make is just a little bit of price action. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. And as we talk a lot about concepts, we sometimes talk about, epistemology, quantum physics, then we talk about daily price movements, we talk about engineering practices, we talk about earnings calls. We encompass a whole spectrum of things. And I don't want to diminish the importance of just looking at market prices. This is important. It's not, most of the time it's not important. A lot of people waste their time doing that, but sometimes it is. And I think right now is a good example to point out. And this would be if you look at the stocks of copper companies such as Antofagasta or Lundin Mining, which are two pure play copper companies, they have peaked at the beginning of the May and then started deteriorating. And this is a good signal for the reversal of the value trade towards innovation. If you also look at, let's say, our portfolio has had a massive reversal since the beginning of May. It's not clean, of course. There's a lot of noise in this type of analysis. But if you look back, let's say 6 months hence, so let's say towards the end of this year, if we look back, and assuming we're right about this rotation, I think this will be the beginning of May when these copper stocks start deteriorating. Now, copper is sometimes called doctor economy because copper is a very good indicator for the old economy. Copper is what you need to make things, and most things are basics things, not innovation things. Or in other words, the copper content of innovative products is very small, but the copper content of basic products is very large. So if copper prices go up, that means that value companies will do well. If copper prices stagnate, that means that innovation companies do well. Of course, again, there's a third scenario where copper doesn't do well and we have a recession. That's not what I'm talking about here. I'm just talking about a general economic growth scenario where innovation does better than value. Thank you.